Hello, everyone, and welcome to another episode of Idiot Investor. I am your host, Justin Alexander, and today I wanted to go over how to invest, how to start investing, because this is a question I kind of saw among my friends, and they were kind of talking about maybe getting into it, and so that'd be cool. Just some general guidelines for how to get into the stock market. First of all, you need to have money. The general advice I've heard is to pay off high interest debt. So that'd be like credit card. That'd be 25% or 12%, whatever that threshold is. You probably don't need to pay off your student loans. I don't know what the percentage is on those, but if it's not crazy. But, there's also the idea that if you can get better returns with that money in the stock market, maybe getting 7% a year, is that better than the 3% that you're paying? Also, to have 3 to 6 months of expenses, your living expenses, rent and food, and you should have that locked down. You should have a good safety budget, not budget, but some cushion. You should be able to save. You should be maxing out your Roth IRA first, especially if you're in a low tax bracket, because the regular IRA helps if you're in a high tax bracket, because you can take that money out of your taxes. But if you have a Roth IRA, you're allowed to put that money in, and it just grows and grows and grows and grows, and you don't have to pay any taxes on the gains, and you can even day trade in that account, and no taxes. So if you could even do all your trading within the Roth IRA if you have a low amount, if you don't need the money, if you're sure you don't need it, and then the rest. And there's other options as well for tax advantaged accounts, like the health savings account, or I believe it's called 519 plan. And those are for children, so they can attend college. You have to spend it on that, or medical bills for yourself with health savings account. You'll have to do your own research, because I have not opened up any of those. But as far as regular individual accounts goes, I would suggest Schwab. They're the largest provider of financial, I don't know, whatever it's called, brokerage. Thank you. So that's where they stand. So I would go with Schwab, because they bought TD Ameritrade, and that's the other big one. So they're going to combine those, and Schwab's going to be the main one. So might as well get used to the interface now. And I think it's really good. It offers free trading, fractional shares. They have their own IRA, so you could do it all there. I only started with Vanguard. I have my Roth IRA in a Vanguard, because when I started a year and a half ago or so, they didn't have free trading. They still had $7 a trade, which is totally absurd. But luckily, Robinhood came along, brought along free trading, and so everybody followed after that. And let's see, Schwab, Vanguard, there's Fidelity, there's some smaller like Acorn. So go with what you're comfortable with. I like Robinhood for crypto, because you're allowed to do limit orders, which I think some places you don't, and there's absolutely zero trading fees, which is great for crypto, because that's kind of rare. You can go on Coinbase and you won't be able to do free trades. So that's good for Bitcoin and all those. Goddamn, 500%. Oh man, I wish I didn't think of it as a joke back when it was $3,000. Damn, man. I remember watching Bitcoin and being like, oof, big oof. But now it's crushing it, obviously. So yeah, you need money for the stock market. All right, and then most investors don't beat the stock market. I think it's something like 70% of people don't do better than just an S&P 500 ETF. This S&P 500 is up 100% the last 5 years, and then there's many good stocks that aren't up that much. For example, Pepsi is one I own and has not been crushing it that hard recently, only up 30%. So even companies that you think would be great, like Coke and Pepsi, old school names, are only up 15%. So along with dividends, can't forget that. But that's kind of how it goes. But that's why it's important to get the S&P 500 and just the general market. Like you could go VTI is another good one. The total stock market. It's got about the same returns, slightly more because it has a small cap included and mid cap. So that's why it's different. I'm getting a lot of notifications. How do I turn this off? I can't. I'm sorry, you guys. There's international is another thing to consider. Has not been doing as well, but past performance is not indicative of future performance. So I think with them underperforming, international could really shine, and it has been recently. I don't want to get too much into the individual holdings. You should be diversifying, though. You can look at the both Schwab and Vanguard have portfolio overviews, and all right, so let's see if this works. I'm looking at my Vanguard portfolio. I have about 2 years, or about 1.5 of has it been 2 years already? Technically, I think I have about $12,000 to $15,000 in there. And it breaks down. This is how you should be diversified. So, materials is 3% of the U.S. stock market. My portfolio, it's 2.4%, and there's a difference of I am under 0.6. So you can extrapolate. Telecommunications at 10%. That's like Disney, AT&T, Verizon. Materials is like gold miners and physical copper and gold, silver, stuff like that. Consumer cyclical, that would be your Amazons, Teslas, Walmart, things like that. Consumer defensive, those are the old school names like Coke and Pepsi. Some other ones, energy, pretty self-explanatory. That's old school, natural gas, coal, energy pipe and transfer companies, storage. And you'll notice that's the smallest portion in the U.S. stock market. So it has a very small influence. Financials is surprisingly large at 13%. But there's like banks like JP Morgan, Bank of America, Citigroup, health insurers. Well, yeah, I think that's under financial. American Express, Visa, I think those would be under. That actually might be tech. Healthcare, 15%, surprisingly large, but that's what they've allowed to happen. These healthcare companies can charge, arm and leg and fuck the little guy, right? So that kind of pisses me off. Industrials, those are your Boeings and industrial, stocks. They make things. Real estate, I think that includes like household real estate as well, maybe houses, or that might be specifically commercial things. Infotech is obviously the largest, 24%, and tech dominates the market. It's Apple, Microsoft, Adobe. That's what America is basically. So That's obviously a good place to be. And utilities, not as much household names, but they're regulated and they pay a good dividend. And um, yeah, so you should be diversified against all those sectors. You should have a little bit in each. You should be close. You shouldn't be over or too far under in each. And you could swing towards value or more towards growth. I like to keep it somewhere in the middle. Then you could diversify large cap, mid cap, and small cap. It's good to have those differences because they do move differently. And so yeah, it's good to have international. That's the other option. I have a very small amount, only 5%, but I think shouldn't go crazy. U.S. is, in my opinion, the place to be. But so yeah, and then you would open an account with Schwab or Vanguard. It's very easy, and you contribute money. It's not automatic, and the investments aren't automatic either. When I first got a Roth IRA, I thought I just put money in and it grows, and they invest it and put it in whatever. But no, you need to do the research yourself and understand what you're investing in. And so that could be individual companies, or that could be the S&P 500 ETF like VU. And it's just simple. You could buy this fractionally. So if you only have $20, you could just throw it at it. Because if you bought $20 down here at the bottom, you would have almost doubled it. It would be worth $40 now almost. So that's kind of how that works. Even with fractional shares, you can still get a fractional amount back. And there's taxes, so they send you all that, and it's just not that hard. There's different types of companies like Master Limited Partnerships. Those give you a K1 at the end of the year. It's a little different, but for most regular stocks like Disney and whatever else, they'll send you a investment, whatever. That's it. Then you brag to your friends online, basically. Just kidding, but I hope that helps. It could probably be a little more clear. I'll probably do another one of these one day. But there's lots of good resources out there. Investopedia, Morningstar, even Schwab and Vanguard themselves have information that you can find. So, don't be discouraged, and always keep it up. It's always good to stay in, never get fully out unless you really need that. So, all right, thanks for watching, and until next time, keep investing. All right.